Welcome to this explainer. All right, let's dive right into a massive financial mystery that's currently unfolding in the bioeconomy. In Peter Lynch's investment frameworks, the most lucrative but definitely the most complex category is often the turnaround. We spend so much time looking at companies trying desperately to claw their way to higher revenues, but what happens when a company actively shrinks its top line, yet somehow becomes wildly more profitable? Well, that is the exact turnaround puzzle we're decoding today with Green Plains Inc.
Seriously, just look at this dynamic. How does a company lose more than a quarter of its revenue? We're talking a massive 25.89% year-over-year drop, yet somehow manage to turn a devastating $72.6 million loss into a $33.5 million profit. That is a positive swing of over $106 million to the bottom line, all while the top line is actively shrinking. It completely defies traditional commodity market logic.
So, let's look at part one, the revenue-profit paradox. To really understand this paradox, we've got to look closely at Green Plains, ticker symbol GPRE, and their stark Q1 2026 earnings data. In Q1 2025, they generated over $600 million in revenue, but they were literally bleeding cash, posting an operating loss of over $62 million. Fast forward exactly 1 year, revenue plummeted down to $445.8 million. Yet, operating and net incomes just rocketed right out of the red. They posted an operating income of $44.8 million. Benjamin Graham always warned investors to look past pure revenue size and focus on actual earnings stability, right? Well, this $100 million swing to the bottom line shows you exactly why.
Moving on to part two, drivers of the turnaround.
You see, you don't just execute a $100 million profit swing by crossing your fingers and hoping for the best. Looking at their own data, Green Plains achieved 97% of their production capacity and secured a consolidated ethanol crush margin of $64.6 million. By strictly prioritizing repeatable margin capture and safe execution, they essentially built a foundation of pure operational excellence that allowed this massive turnaround to actually take root. Which brings us to part three, the carbon capture catalyst. The real hero of this turnaround is a revolutionary pivot toward a low-carbon platform. Green Plains is currently capturing CO2 at 3 of their Nebraska plants and piping it all the way to Wyoming for permanent sequestration. This single initiative is unlocking an expected $200 to $225 million in EBITDA for 2026, driven directly by 45Z clean fuel production tax credits. To put it in Warren Buffett's terms, they are building a massive economic moat here. They're transforming standard ethanol into a decarbonized premium asset that is completely shielded by government tax incentives. Now, if you're wondering whether this is just some pie-in-the-sky corporate guidance, it absolutely isn't. They've already validated the model by receiving their very first $14 million payment for transferred 2025 tax credits. This proves we aren't just talking about theory. This is cold, hard cash hitting the balance sheet right now. And as they keep lowering their carbon intensity, that credit value per gallon is only expected to increase.
All right, part four, crushing the competition.
This new strategy fundamentally changes their position against traditional industry rivals, who, frankly, are still playing by the old rules. While competitors fought tooth and nail for a meager 1% revenue increase this quarter, Green Plains actually let their revenue drop, just to prioritize margins. The data shows Green Plains posting a 7.51% net margin compared to the competitor average of just 1.39%. Sure, their competitors hold the vast majority of revenue market share, but Green Plains is capturing exponentially more actual profit per dollar earned. They are intentionally choosing margin over market share. As CEO Chris Osowski points out, this precise execution of their carbon capture initiatives is exactly what separates them from the rest of the commodity market. They're applying a culture of continuous improvement, measuring absolutely everything, and leaning hard into sustainable tech to generate those higher, predictable free cash flows. And as we know, those cash flows are absolutely essential to any solid discounted cash flow, or DCF, valuation.
Finally, part 5, insider confidence and outlook.
The final piece of the puzzle here is figuring out whether management is actually betting their own money on this transformation. Legendary investor Peter Lynch always cited heavy insider buying as one of the absolute strongest bullish indicators a stock can have. Well, according to recent data from Quiver Quantitative, director Patrick Francis Sweeney recently purchased over $100,000 in GPRE stock on the open market, increasing his personal holdings by nearly 18%. When directors buy at that kind of scale, it signals massive internal conviction in the future cash flows of the strategy.
So, what's the big takeaway from this explainer? It's a truly fascinating example of strategic evolution. It shows us how letting go of sheer revenue volume in order to focus on tax-incentivized, sustainable technology can completely redefine a company's balance sheet. Green Plains essentially stopped trying to outproduce everyone else and instead decided to out-innovate them.
Which leaves us with a massive question to ponder. As environmental policies and tax incentives like the 45Z credit continue to shape the market, will this paradox of shrinking revenue and explosive profit become the absolute new blueprint for the future of agriculture? Are we witnessing the death of the pure commodity producer? I'll let you be the judge of that. Thanks for joining me on this explainer, and definitely keep your eyes on the data.